All right, welcome to Talk Tickers. Today we're digging into SentinelOne. Their latest earnings call just dropped on December 4th, and, on the surface, it looked like a total home run. But then you look at the market's reaction, and it's clear they saw something to worry about. So the big question is, what did they see? Let's get into it.
And really, this is the central mystery we're going to unpack. Think about it. SentinelOne comes out. They beat analyst expectations on both revenue and earnings, a classic double beat. And yet, the very next day, the stock just tanks. We're talking over 14%. So what on earth did the market see that the headline numbers just didn't show? Let's break this whole thing down.
Okay, so first up, let's just look at the raw results, the stuff everyone saw right after the bell. And honestly, by pretty much any standard measure, this was a very strong quarter. It showed really solid execution and some great momentum.
So let's start with the bottom line. They beat expectations by 2 cents. They delivered non-GAAP earnings per share of 7 cents when Wall Street was only looking for 5. So, this wasn't just a tiny little beat. It was a really clear signal that profitability is growing. And no surprise, the top line looked just as good. They beat the street's revenue estimate by a cool $2.7 million, bringing the total to just under $259 million. And get this, that's a 23% jump from a year ago. So yeah, another clear win. But this quarter, wow, it marked a huge milestone for them. SentinelOne officially crossed over $1 billion in annualized recurring revenue, that's ARR. For any software company, that is a massive deal. It's a huge psychological and financial level that signals, hey, we've made it. We have significant scale. Okay, now this is where it gets really interesting. We're talking about the profitability inflection. Just look at this incredible swing in their non-GAAP operating margin. A year ago, they were basically burning cash, right? Down at a negative 5% margin. This quarter, bam, they completely flipped it to a positive 7% margin. That's a 1,200 basis point improvement. That's just a brilliant illustration of their new focus on financial discipline. So, with all that good news, where did it all go wrong? Well, it turns out the market wasn't really looking at the past quarter at all. Nope, it was looking forward, and it really didn't like what it saw. This is a classic case of the company's story hitting a wall of reality. Yeah, so on one side, you have the story management is telling, right? They're talking about durable growth, operating leverage, this new path to sustain profitability. It all sounds great. But then on the other side, you have the market's reality. And investors, they basically ignored all that and zeroed in on just two things: a kind of soft revenue forecast for next quarter and some sudden, uncertainty in the C-suite. The CEO, Tomer Weingarten, he was super clear with his message. He literally said, "We've put the company on a path towards sustainable profitability." And you can tell that was meant to be the headline. It was this big signal that the company had finally grown up, moving away from that growth at all costs story to being this disciplined, profitable enterprise. But the market just had other ideas. So here's the bottom line. Two specific things just completely overshadowed all those great Q3 results. First, that Q4 revenue guidance, it came in just a little bit light. Okay, fine. But second, and this one was probably way more jarring, was the surprise announcement that the company's CFO, Barbara Larson, was leaving. Okay, let's actually look at the numbers here. So management guided for Q4 revenue of $271 million. Now that might sound okay, but it was just below what the street was expecting, which was around $273 million. And look, it's not a huge miss, not by a long shot, but for a high-flying growth stock, any sign of deceleration can get punished, and punished severely. Now, that second issue, it introduced the one thing investors absolutely hate: uncertainty. A sudden CFO departure is like the textbook example of key person risk. See, Barbara Larson was seen as the person who was really instrumental in guiding the company to profitability. So for her to leave, especially right at this moment, well, it just raised all sorts of questions about stability and whether that new financial discipline was really going to stick around. All right, so we've seen the strong quarter, and we've seen the kind of weak forward look. Now let's put it all together and figure out what this really means for the stock going forward. And we'll start with our official rating. So just for some context, it's really important to see how SentinelOne has actually been doing lately. Over the past year, the stock is down a lot. We're talking around 40 to 45%. Now, during that exact same time, the broader cybersecurity ETF, which is Hack, is actually up over 12%. That is just significant long-term underperformance compared to its peers.
So when you take everything into account, our rating for SentinelOne is market perform. And here's why. The whole story has fundamentally shifted. The company proved it can be profitable, which is great. But that good news, well, it seems to be priced into the stock already. So now the big question mark has moved away from the bottom line and right back to the top line. The question is, can they get that growth engine started again in what is a very competitive market? And until that question gets answered, we expect the stock to pretty much perform in line with the market, but not necessarily beat it.
All right, and now from our final segment, the one you've been waiting for. This is where we pitch a plausible hedge fund style trade idea based on everything we've just talked about. This is where we connect all the dots, from the earnings call directly to a potential market opportunity.
So here's the thesis. What if, just what if, that 14% drop was a massive overreaction, right? I mean, the market punished the stock for a tiny little guidance tweak and a CFO change, and in the process, it completely ignored that incredible 1,200 basis point swing in operating margin. So the trade idea here is a bit contrarian, and it's bullish. It's buying out of the money call options. Now, this is basically a low-cost bet that the stock is going to rise, and rise significantly. For example, maybe you'd look at buying the March $16 strike calls. The bet is simple. As the dust settles, the market is going to wake up and refocus on the new profitability story, causing the stock to bounce back. Now, what's the risk? Well, the main risk, of course, is that those growth concerns are totally valid. If the stock just sits there and stagnates, those options could expire completely worthless.
And of course, we always have to close with this. The analysis and the trade idea we just talked about, well, they're for informational and educational purposes only. This is absolutely not financial advice. Please always do your own homework and consult with a professional before you make any investment decisions.